Hi everyone and welcome to our channel. Today I'm talking about ASC 350, a section of the Accounting Standards Codification that deals with intangible assets. These are assets with no physical substance, like patents, trademarks, copyrights, and goodwill. Let's dive into the essentials. To recognize an intangible asset, ASC 350 lays out three criteria. 1. Separable or identifiable. The asset can be separated from the company or identified on its own. 2. Future economic benefits. It must generate future cash flows or other benefits. 3. Control. The entity must have control over the asset, meaning it can use it and prevent others from doing so. For example, if your company develops a proprietary software, it may qualify as an intangible asset if it meets these criteria. Now, let's talk about measurement. There are two main methods. 1. Cost method. You record the intangible asset at its historical cost, subtracting any accumulated amortization. 2. Fair value method. This measures the asset at its current market value. The cost method is more commonly used for assets like patents and trademarks. On the other hand, the fair value method might apply during acquisitions or when revaluations are required. Let's take an example of a company that acquires a patent for $100,000. The patent has a useful life of 10 years. Using the cost method, the company would amortize the patent over its useful life, which is $10,000 per year. At the end of the first year, the carrying value of the patent would be $90,000. This information would then appear on the company's balance sheet and in the notes to the financial statements, along with details about the nature of the patent and the amortization expense. Now, let's talk about goodwill, because it's treated differently from other intangible assets. Goodwill arises when a company buys another company for more than the value of its net assets. For example, if your company pays $10 million for a business whose assets and liabilities are worth $8 million, the extra $2 million is goodwill. Here's the key difference. Goodwill is not amortized because it doesn't have a definite life. Instead, goodwill is tested for impairment annually to ensure its value on the balance sheet is accurate. Imagine your company acquires another company for $10 million, creating $2 million in goodwill. A year later, the market shifts, and the business unit linked to that goodwill performs poorly. After performing an impairment test, you find the goodwill's fair value is now $1.5 million. You'd record a $500,000 impairment expense, which reduces both the goodwill on your balance sheet and your company's net income for that year. This process ensures your financial statements reflect the true value of your assets. Disclosure is another key aspect of ASC 350. Intangible assets, including goodwill, must be reported on the balance sheet with additional details in the financial statement notes. This includes the nature of the intangible asset, its carrying value, any impairment or amortization charges. This transparency ensures stakeholders understand the value and usage of these assets. To wrap it all up, 1. Intangible assets with definite lives, like patents, are amortized over time. 2. Intangible assets with indefinite lives, like trademarks, are tested annually for impairment. 3. Goodwill is not amortized but requires an annual impairment test. These rules ensure that companies report their intangible assets fairly and accurately. ASC 350 might seem complex, but it's all about ensuring transparency and accuracy for intangible assets. I hope this breakdown made it clearer for you. If you found this video helpful, give it a thumbs up, subscribe to the channel, and hit the bell for more accounting insights. Thanks for watching, and I'll see you in the next one.